Blockchain Daily News, February 22nd, 2024. Bitcoin surges. The U.S. banking industry is anxious. Bitcoin liquidity shifts to the United States. Spot ETFs reshape the cryptocurrency market. Thanks to the newly launched U.S. Bitcoin Exchange Traded Fund, ETF, Bitcoin trading on U.S. cryptocurrency exchanges appears to be easier than on overseas platforms. According to data from research company Keiko, so far this year, trading activities in U.S. trading venues account for nearly half of the buying and selling activities within 2% of the central price of Bitcoin on average. This statistical range spans the launch of the U.S. Bitcoin Spot ETF. Trading behavior where the bid and ask prices are within 2% of the mid-price allows orders to be executed without excessively disturbing the price. The greater the number of this indicator, the better the liquidity. According to this metric, non-US platforms account for the lion's share of Bitcoin market depth in 2023. On January 11th this year, 9 US Bitcoin ETFs debuted, and the Grayscale Bitcoin Trust, which has more than a decade of history, also converted to a Bitcoin ETF on the same day. The growth, which includes BlackRock and Fidelity Investments, has attracted $5 billion in net investment inflows to date. The anticipation and launch of these products has spurred the price of Bitcoin to double over the past 12 months. On the one hand, thanks to the increase in funds brought by spot ETFs, Bitcoin has reversed its previous downward trend and continued to perform strongly. It began to recover the previous price difference and exceeded $50,000 on February 14th, setting a new high since 2021. A new high since December, and then remained fluctuating around $51,000. On the other hand, the much-watched Coinbase Q4 financial report announced that Q4 revenue reached $954 million, achieving quarterly profit for the first time in 2 years. On an annual basis, Coinbase managed asset inflow was $7 billion, and the managed assets by the end of the year were $1,010. $100 million. According to its CEO, Coinbase currently manages 90% of the $37 billion in Bitcoin ETF assets, but this revenue was not included in the Q4 quarter, so its custody revenue will further increase in fiscal 2024. On the one hand, the price of Bitcoin continues to hit new highs, and on the other hand, Coinbase is full of money visible to the naked eye, and all of this seems to have nothing to do with the traditional American banking industry, which is most in line with the public impression and has custody as one of its main businesses. Against this background, US banks finally couldn't sit still. Bitcoin surges, Coinbase earnings report shines. February coincides with the Chinese Lunar New Year, which is full of flowers, and Bitcoin seems to have caught up with this wind of blessing. During the Spring Festival, Bitcoin experienced a surge. On February 9th, Bitcoin rose to $47,000. On February 11th, it exceeded $48,000. On February 14th, Bitcoin exceeded $50,000 and once chased as high as $52,700, and then continued to oscillate at $51,000. Bitcoin price trend, source, Binance. Bitcoin price trend, source, Binance. From the market perspective, when it comes to the reasons for the increase, although the halving is gradually approaching, it mainly comes from the net inflow of funds brought by Bitcoin spot ETFs. Judging from the data, as of February 15th, the total number of Bitcoin holdings in 11 ETFs has exceeded 720,000. Although Grayscale is still in a sell-off state, with a total outflow of 15.97 coins, other ETFs are in an inflow state. According to a post on the X platform by CoinShares Research Director James Butterfield, as of February 14th, the total net inflow of US spot Bitcoin ETFs has exceeded $4 billion. According to data from BitMEX Research, the Bitcoin spot ETF saw a net inflow of $2.2734 billion last week, and the total net inflow since January 11th reached $4.9269 billion. Coincidentally, Coinbase Q4 quarterly financial report was also released after the market closed on February 16th. Overall, the financial report is undoubtedly extremely eye-catching. Affected by high compliance costs, and supervision. Coinbase's performance after listing was far inferior to that of large offshore exchanges such as Binance. Especially in the past 2 years, the market downturn directly led to a double decline in Coinbase's performance and stock price. However, in 23, in the last quarter of the year, Coinbase finally ushered in a rare perfect ending. Affected by the rise in the cryptocurrency market, Coinbase turned a profit in the fourth quarter and achieved a net profit of $273 million, fully reversing the loss of $557 million in the same period last year. For the whole year, it achieved a net profit of $95 million. Net income and adjusted EBITDA of nearly $1 billion brought total revenue to $3.1 billion. Coinbase income, source, Coinbase official website, Coinbase income, source, Coinbase official website. A closer look at the financial report shows that Coinbase revenue is mainly divided into two parts. One is transaction revenue, and the other is subscription and service revenue. From the perspective of trading revenue, due to the relatively sluggish crypto market last year, Coinbase trading revenue throughout the year is still showing a downward trend. The overall trading revenue in 2023 will be $1.5 billion, a year-on-year decrease of 36%. The total trading volume was $468 billion, a year-on-year decrease of 44%. The ordinary user trading volume was $75 billion, a year-on-year decrease of 55%, and the institutional trading volume was $393 billion, a year-on-year decrease of 41%. However, the decline in transaction revenue was offset by an increase in subscription and services revenue. The total subscription and service revenue for the year was $1.4069 billion, with the most obvious growth in the fourth quarter, achieving subscription and service revenue of $375 million, an increase of 12%. The main driving factors for the growth were stablecoin income, interest income, and blockchain rewards, staking, and price increase factors. Among them, stablecoin revenue was $171.6 million, higher than $145.7 million in the same period last year. Blockchain rewards were $95.1 million, higher than $62.4 million in the same period last year. Custody fee revenue was $19.7 million, higher than $145.7 million in the same period last year. Compared with $11.4 million in the same period last year, interest income was $42.6 million, higher than $36.5 million in the same period last year. Other subscription and service revenue was $46.5 million, higher than $26.7 million in the same period last year. Coinbase subscription and service revenue. Source: Coinbase official website, Coinbase subscription and service revenue. Source: Coinbase official website. It is worth noting that in this financial report, because the ETF was passed in January 24, the custody income of the Bitcoin ETF, which has attracted much attention, was not recorded, but as the custody of 8 major institutions among the 11 spot Bitcoin ETFs currently, it is custody of about 90% of ETF assets. This revenue will be disclosed in the Q1 quarter of 2024, which means that Coinbase revenue still has a lot of room for growth. Indeed, according to the CEO, the company expects first quarter subscription and service revenue to be between $410 million and $480 million. Bitcoin continues to grow, and the corresponding direct institutional income has become increasingly prominent. This has undoubtedly attracted the red eyes of other institutions. What is immediately unsettling is the US banking industry, which was previously skeptical of encryption. After all, from a functional perspective, you see, the business related to fund custody is the main source of income for many banks. Judging from the timeline, before 2020, only specific encryption custodians can provide cryptocurrency custody services. At the same time, a trust charter needs to be issued by the National Financial Regulatory Agency, and the procedures are complicated and cumbersome. At that time, although there were no actual laws and regulations prohibiting banks from hosting cryptocurrency, due to risk and size considerations, there were very few banks engaged in this field. The situation was improved until July 22, 2020, when the Office of the Comptroller of the Currency, OCC, an independent agency under the U.S. Department of the Treasury, issued an open letter clarifying that national banks and federal savings associations have the legal right to custody cryptocurrency assets. A number of banks, led by Loan Bank, have begun to get involved in the crypto asset custody business. The good times did not last long. After experiencing the FTX incident in 2022, the U.S. authorities realized that there was a possibility of transferring crypto asset risks to systemic risks, and crypto regulations were quickly tightened. Three major federal banking regulators issued a joint statement emphasizing the risks of crypto asset risks to banking institutions, implying that banks should not engage in crypto-related business. In January 2023, the U.S. Federal Reserve Board, FRB, decided to reject membership applications from cryptocurrency-focused custodian banks. From 2022, the consensus that banking regulators were cautious and skeptical about cryptocurrencies and their risk exposure in the financial system basically penetrated the entire financial industry until the adoption of the Bitcoin spot ETF this year. On February 14 this year, SEC Chairman Gary Gensler received a special Valentine's Day letter. The letter was sent by the Bank Policy Institute, the American Bankers Association, the Securities Industry and Financial Markets Association, and the Financial Services Forum, requesting that they amend Staff Accounting Bulletin, SAB, 121 to improve the situation in which cryptocurrencies are restricted in the banking industry. Screenshot of the letter sent by banking institutions to the SEC. Source: American Bankers Association official website. Screenshot of the letter sent by banking institutions to the SEC. Source: American Bankers Association official website. The communiqué was issued by the SEC on April 11, 2022. The communiqué stipulates cryptocurrency custody and requires financial institutions, credit unions, and banks that provide crypto custody services to retain a certain amount of funds to support their customers' digital assets. To put it simply, in order to ensure transparency, the custodian institution needs to include crypto assets in the liability column of the balance sheet, and to ensure the balance of assets and liabilities, the asset column should also increase by the same amount. This will undoubtedly increase the custody cost of the custodian institution. It also violates the basic principle of equal treatment of assets. The letter clearly expresses dissatisfaction with this provision and believes that regulated banking organizations are prevented from providing digital asset protection services on a large scale, and investors and customers, as well as the overall situation of the financial system, will be negatively affected. It also emphasized that the on-balance sheet requirements, combined with the overly broad definition of crypto assets in SAB 121, will have a chilling effect on banking organizations' ability to develop distributed ledger technology, DLT, applications. Of course, the SEC does not agree with this, saying that accounting guidance is necessary. Compared with other assets held by banks for customers, crypto assets have unique risks and uncertainties. It is important to maintain transparency and risk hedging. Gary Gensler even bluntly stated in an interview that the cryptocurrency industry lacks appropriate and necessary disclosures related to securities. In fact, it is not just the banking industry that has expressed dissatisfaction with the regulations. The differences in attitudes towards encryption between the two parties have also made the regulations face huge controversy. As early as August 22nd, Senator Lummis sent a letter to the U.S. Comptroller General questioning whether the regulation complied with the rules stipulated in the Congressional Review Act. Later, in January 2023, Cynthia Lummis and U.S. Representatives Mike Flatt and Wiley Nickel once again introduced a resolution to determine that the announcement had no legal effect. As of November 23rd, the resistance to SAB 121 has not stopped, with a memo from members of Congress asking for clarification on the Government Accountability Office, GAO, findings and questioning its enforceability. Judging from the current results, although the game between the two parties is still going on, the attitude has been made very clear. Compared with the previous dismissive attitude, the current Bank of America hopes to actively participate in the custody of Bitcoin ETFs. obtain custody fees and possibly other fees, and start pressuring regulators to that end. In the long term, due to security considerations, the status quo of Coinbase alone will inevitably be unsustainable, and the increase in the diversity of custody institutions is also an objective trend. The intervention of mature banks has a positive effect on the development of the crypto industry. On the one hand, it can force custody institutions to improve security and transparency and reduce custody costs. On the other hand, this move has once again increased the mainstream popularity of crypto assets. From a common sense point of view, banks have always been the most important part of the financial system. Banks' access to crypto will once again lower the threshold for crypto assets and broaden channels for public participation. Of course, the accounting regulations will not be adjusted in the short term, and the bank's operations will inevitably be suspected of being eager for quick success. But the world is bustling and everyone wants to benefit, and there is no shame in wanting to get a piece of the pie. As Bitcoin gradually enters the mainstream, spectators will eventually become accustomed to the reversal drama of Hedong and Heshi in the past 30 years.